Welcome back to the Max Your Dash podcast. Thank you for listening, liking, and now watching. As usual, I'm your host, Steve. My co-host, Nate, here again. Mark is back. We fired Adam. It's kind of like a whole thing.
Ratings are down.
Mark and Adam are fighting for this spot.
Yeah, if you listen, let us know who you like better, Mark or Adam.
Please say Adam.
Mark goes yesterday. He's like, if you guys want me on every time, like, that's fine. You know, it's completely up to you guys. But, whatever you want to do.
Well, it's taking up time on the calendar.
Right.
Yeah, but this is fun, though.
Talk to your
it is also a free lunch break when you guys, just cancel on me.
We don't do that often, do we? Oh my gosh, I didn't give you guys time to think about your Max Your Dash moments. If you're new here, we do a Max Your Dash moment in the beginning of the episode. So we talk about fun, happy.
Make sure you tell them to.
Yeah, of course. Max Your Dash moments. Time we were feeling most fulfilled since our last episode. Just spreading good things we've been doing. But as Nate just said, if you're watching this and you're not subscribed, which is like 80% of you, I looked at the analytics, like 80% of people watching our episodes aren't subscribed.
It's a lot of robots.
It's like they're purposely trying to hurt our business model.
Yeah, dude, it's crazy. So please hit the subscribe button and click the little thumbs up too. Leave a comment. Let us know what's going on. We would really appreciate it. Max Your Dash moments. Boom.
You're gonna make me go.
Yeah, I'm thinking of mine too right now.
Yeah.
Wait, are you guys doing anything for Memorial Day?
I got a packed weekend of barbecues and yard work.
Yep.
Max or Dash moment for me. I can't use the PGA because I used that in our last episode. That hasn't dropped yet.
So the PGA Championship was actually 2 weeks ago. If you're listening to this,
okay. All right. I know what I'm gonna do. I told you guys I'm gonna be bringing up food a lot. Last night. This is easy. What am I talking about? So this past weekend, I went down with my buddy to do a turkey hunt. Andy Steiner. He's definitely got to be a subscriber. We had a blast. We had such a good time. I got 2 turkeys tagged out. We had an absolute riot. Last night I made turkey fajitas on the grill. So good. Little thin strips, seasoned with fajita seasoning, peppers, onions, char grilled.
Where do you guys stay when you're doing this?
So I just stayed at this house.
Oh,
mud huts.
Dude,
but like the process of hunting to the dinner table is so much joy for me. You guys know that.
Yeah, you do love that. All right, I'll go. Like I told you guys in a couple episodes prior, my pops has lost a lot of weight, so he's been like lifting weights and stuff. And we worked out together. And it was fun. Never worked out with my dad. You guys know I mean, I don't like working out anymore, but I do it. So it was weird doing it with him, but it was fun.
Remember when we used to work out together, you and I, and you would put me through the absolute most brutal.
Yeah, I did that purposely.
Workouts of all time. We had to hang from the bars afterwards to try to get the blood like out of your shoulders. I was smoked.
Those were simpler times, Nate. Simpler times. No, we weren't filming a podcast.
Yeah, we were just at the gym.
All right, Mark. I bet I can guess yours before you go, but you can go.
No, I don't. Well, the normal ones are what? Golf, bourbon,
and Enzo.
I'm okay.
He's Duncan.
No, I wasn't gonna pick that one, but it was a funny video. No, I had new brother-in-law and sister-in-law's wedding this past weekend, which was a lot of fun. Met some cool people there, but the part about Enzo, he got in some overalls and bow tie thing. And I was just dying laughing. It was awesome. Too funny seeing him like that.
Dude, it's your first is that your first wedding of the season? Dude, that one year you literally had like a wedding every weekend.
Yeah, I mean, we got a few more I think this year, but no, but he wouldn't move, wouldn't talk to anyone basically the entire time we were there, and like he wasn't there for long. He was there for like 35 minutes. But as soon as they turned the music on for everyone to start walking down the aisle, that was when he decided he wanted to get on the ground and run around.
That's amazing.
So I had to take him outside, and he was just splashing his feet in the puddle and, doing his thing. So we missed the whole reception or ceremony. Mm-hmm. So, but yeah, it was fun.
Sounds like we did some stuff. Right? I mean,
Yeah.
It was an action-packed weekend.
Yeah.
Sounds like.
now it's Memorial Day. All right. Talking about the stock market today. Last episode was when? April. We talked about the market. So some stuff has happened. End of April, you said?
April 19th.
It is. We are filming this on May 25th. So
since then, I think we had a Fed meeting. We got to talk about that.
yep. We got some inflation numbers.
Inflation. We have the debt ceiling approaching.
Mm-hmm.
Are we going to default? What does that mean?
Never have before. So I'm sure they'll just keep increasing the debt ceiling.
The U.S. has been downgraded before, though.
They have. They just never defaulted on their debt.
Mm-hmm.
I just saw something.
A lot of people. This wasn't on our agenda, but let's talk about this for a second. A lot of people definitely buy into the hype around this.
Mm-hmm.
So maybe we should explain how this
Well,
works.
it's like a buzzword. Everyone loves talking about the
oh my
the
god,
debt.
we're going to default on our debt.
We're truly
What is that?
yeah.
It becomes very political. What does it mean?
So if they don't raise the debt ceiling, then next month, if they do a government shutdown, they're not going to be able to pay the interest on their debt.
Well, so if they don't increase the limit on their credit card bill, you're saying?
Yeah, pretty much. So they won't. I think they right now have to borrow more money so they could pay the interest on their debt.
That's hilarious.
So this is federal net debt as a percentage of GDP in 2023 is 98%. So 98% of our GDP is the same as our debt ratio, projected by 2033 to be 118.2%.
Mm-hmm.
It
sounds very concerning.
Yeah.
But this happens all the time.
Yeah. Yeah, they've raised the debt ceiling something like it's like 70 times since like 1960 or something like that. So they do it all the time. It more than likely is going to happen, but it is a real problem. We do need to fix it. They have to get this under control. I mean, we can't keep running at a deficit and spending more than our country's GDP. That's not good.
Mm-hmm. Pay your taxes.
God.
The government needs your money.
Yeah. So I don't envy the person that's going to have to fix this. Or hopefully they do fix it, but maybe not. Maybe they'll just keep increasing the debt ceiling.
So if you're new to our market commentary episodes and you're watching or listening this, we like to just talk about the biggest things that have happened since the last episode. But the most important thing is like, how does it impact you? What does it mean for you? So you can, because you probably hear a lot of stuff like throughout your day or week or month about stuff that's going on in the stock market. But the most important thing is like, okay, what does this mean for me? Do I need to make any changes? Like, should I be things are going through your head, and that's what we try to answer for you in these episodes. The biggest things that happened, and then what does that mean for you?
So the risk of a default here would be until they figure it out. Any interest on like money market funds or short, treasuries, they're gonna that interest won't get paid out in that month, but they will make up for it. They'll get that back. Mm-hmm. It's very unlikely to change.
And it's like it's political posturing. Mm-hmm. The Republicans and Democrats are going to fight this thing to the last possible minute to then strike a deal. And it's just going to sound really bad. And it's the Republicans' way to make the Democrats look bad. And Democrats are going to try to make it's all bullshit.
Mm-hmm.
And it'll sound really, really bad. You'll be watching the news. People are going to be throwing the remote at their TV, complaining about the government.
It was a reality show.
It'll just get increased, and then life will be back to normal.
This might be a bad analogy or a perfect analogy, but imagine if you're like you used the government as like your guide, and every time you maxed out a credit card, the plan was to just go get another credit card to give you more limit to spend.
Mm-hmm. Mm-hmm.
Like if that was the plan, that is absolutely awful. So don't use them as a role model. Mm-hmm. When you max out your credit card, okay, no big deal. keep that one maxed out. Just go get another one.
They just weren't on auto pay. They just let that thing keep
They
going.
must not have a
State
monthly
balance.
finance meeting.
What are they doing?
It's not actually that simple, though.
No, yeah, we bring it. Yeah.
There is actually some good to like having the government spending a lot of money.
Mm-hmm.
So what happened in this last Fed meeting?
The Fed raised rates. Well, so part of, well, actually, this is a good transition here. So Fed raised rates were between 5 and 5.25 right now. So what they call the average, 5.13. But one of the reasons that there's a chance of these rates stopping, or I guess not increasing further, and hopefully cuts coming soon afterwards, that is interest that when they issue debt, they have to pay this high interest. So they can't keep having interest be this high when GDP is not even close to the same number, because they have to pay that interest. So there's going to come a time here where, like, I mean, how high can they really go, considering the fact that they're going to have to pay interest? So I would guess that we are nearing the end. Now, probabilities changed a lot.
Remember when we had that thing up of like what the market is thinking? Did we talk about that last time? From when, like, what
I think we talked like either right after the last Fed meeting or something like that. But
Yeah.
Let's recap for a second where we're at. So, and we've talked about this every episode, but I think it's important. The public enemy number one has been inflation. The Fed has been trying to get inflation under control, and we've talked in previous episodes about why that's so important. Where are we at on that right now?
On inflation? Core CPI, headline CPI 5%, core CPI 5.5%, and then the estimate for April for core PCE is 4.5%. So those are all
year over year numbers.
Correct.
And what was it like at its peak? 9 something?
Good question.
I think it was like around 9 or 10 at its peak.
8.9% headline.
Was the peak of inflation.
So the question is it easing fast enough where the Fed can feel good about not raising rates anymore?
Well, it didn't ease in the last
I'm
2
talking
months.
about year over year.
Yeah, so that's something that listeners, this is an opportunity to educate. So when you see the headline number, it's a year over year percentage change. But they do track the month over month percentage changes too.
Yep.
And the month over month went up.
Yes.
So year over year down, month over month up.
Sometimes the month over month, though, too, it's like so skewed based on categories. Like some with used car sales, like certain categories are like much higher, which brings like the month over month number like a little bit more skewed.
Which is what happened. I mean,
Right.
Used cars, they went from negative 9% month over month in March to positive 4.4% in April, which is not great.
So potentially inflation is sticky, right? When you look at that month over month stuff, but
It's not transitory.
definitely not transitory.
Oh my God. That is.
But I saw something, maybe Mark, you know this. Maybe we could chat GPT this. But I saw something from somewhere on Twitter land that like there's basically never been a time where we've gotten inflation under control until the Fed rate was higher than CPI. Like once the Fed's rate is actually higher than CPI, historically speaking, that has like been the thing that has had to happen for it to really truly get under control. And we're kind of now there.
Yeah, is it like right there?
We're like neck and neck.
That's a good question. So could probably figure this out relatively easily, I think.
Well, you just said Fed rate's at like 5.25, right?
Yep.
And CPI was like 5
Right.
Yeah.
year over year. So we're like right there at a standstill. And I think that's it seems like that's sort of the tone of the Fed is they're like, okay, we're not really sure which direction we're going next now.
Yeah.
But we kind of gotten to a better place. We need to now just sort of like monitor.
Yeah.
And no one really knows for sure what's going to happen.
Yeah.
So public enemy number one is inflation. We're getting better there, but it's not gone yet. Public enemy number two, this could become number one, is a recession.
Which
Are we in a
the
recession?
Fed made that enemy themselves.
Yeah. I mean, real
Right.
yields are still negative, so I mean, they probably want to see that not be the case. Like on average, they're positive. So that's not great. So what is it right now? Nominal yield 3.71%, real yields negative 1.82, which is just subtracting inflation off of nominal yields. So nominal yields are kind of low too compared to average, though.
It's this is a weird time, right? Because it's also like how are you in a recession when employment is so strong?
Yeah, I was gonna bring that up. The employment data is so weird, though. Like, dude, we literally track that every single week, and it's so weird. Like, I don't even really understand. But remember we were talking about how they actually get the data is like dumb, but they can't change it.
Yeah, they literally call people's like houses
Landline
or jobs
Yeah.
like employers, and it's a really low. They had I don't remember what the percentage is, but it's a really low percentage of people actually answer these surveys. Like, and it used to be better, but it's like 30 or 40%.
Unbelievable. They must look at more data than they talk about.
Yeah,
because like think about in today's day and age, there must be a better way to do that. Well, what's interesting is we have an interesting perspective on this. Like we work with a lot of clients collectively, and we're not hearing of people getting laid off left and right or things like that. I've heard there's been some people that have, but not very much at all. So I kind of believe that data for the most part. That I don't think that there's crazy layoffs. You see them in the headlines with like Google or Facebook or whatever layoffs, but those people probably get right back on their feet pretty easily.
Yeah. So on the subject of rates,
You can keep talking.
I believe it was like last week or the week before that, looking at the futures. So basically the betting on the probability of no change in rates in June or a hike in June or an ease. A couple weeks ago or last week, it was probably 2 weeks ago. There was the highest probability was no change, and then a little bit towards ease. Now there's the probabilities are pricing at a 43% chance of a hike and 56% chance of no change.
Yeah.
And then into July, 71.8% chance of a hike.
So essentially, the further that you forecast that out, the more of less of a chance they're thinking there's going to be a hike, and then even further out, they're thinking there's going to be an ease, which makes sense. But I think we all kind of think it's going to be higher for longer, right? Yeah.
Yeah, it's right now, it's not looking like an ease until December.
That's what they're thinking.
Right. Right. Yeah, it changes. Like when I look at this in an hour, it's going to be different. So,
Is that long enough?
I think
though?
a lot of people were predicting last year that we were like already going to be in a recession and that like all this damage was going to happen quicker than it's happening. It's very interesting, but it goes to show, like we always talk about, how hard it is to predict anything in the markets.
Yeah,
like there's a lot of like the economy is pretty damn resilient,
right?
So but if you do keep the Fed rate this high for a long period of time, I mean, you are starting to see some interesting, some not so good news, like in real estate and commercial real estate. Obviously, it messed up the banking sector. So some of this stuff like is coming.
Yeah,
probably.
Well, and we were when we track this data, like I said, weekly, and the University of Michigan, their consumer sentiment study. That's like, I don't know why they use the University of Michigan one, but that's always the one they use, right, Mark, for consumer sentiment. And I was talking about how it went down. So the consumer's not feeling like too good about what's going on either. But it's interesting because, what was I going to say? Forgot.
You talking about consumer sentiment?
Yeah. Oh, this is what I feel like. What people care most about for inflation, like they freak out because they hear the inflation numbers and they're like, okay, one, I don't want there to be a recession. They know inflation's bad. But what do they really care about is their food bill, their grocery bill. Like at the end of the day, the average person is listening and like they're most affected by inflation if one, they're going to get laid off because of a recession, and two, because of their grocery bill, right? That's where you feel it the most is in your grocery bill. But that's not going to like, if inflation like ticks down, your grocery bill is not going to come down for a while.
No.
Well,
it's
not
going to go.
It's probably not going to go down at all.
It won't
just not going to go up.
Right.
As fast anymore.
Yeah, like some of the transitory parts of inflation, like some of that stuff does go negative, but it hasn't really happened a whole lot. What was I just looking for here? But so there are some, like you guys said, are we in a recession or we whatever earlier? Data is getting a little bit worse. So like leading economic indicators have been getting worse. It's not on here yet, but retail sales was a pretty big miss this month. It was expected, what was it? 0.8% gain, and it rose 0.4%. That's not good. But people are spending their money on services right now. They're not buying like computers and clothes. But they're still going on trips. So like, plenty of that going on.
And earnings have been really good, right? You had some data on that.
They were surprised. Now they're still technically like earnings recession, but they're back on the rise. Yeah. Let's see here. Earnings per share year over year growth 10.9% versus the average from 01 through 2022, 8.4%. So that's a good number. Profit margins through quarter one, 11.8%. So one of the reasons why you're not seeing like the stock market just completely crumble, and we'll talk about some other reasons in a little bit here, but companies have been able to successfully pass along these higher costs to the consumer. So
we're just raising prices.
Yeah. Yep. Yeah. So we're taking it on the chin, continuing to pay for stuff. But something to be paying attention to is credit card balances are also not looking great. So 9.8% through quarter one, debt service ratio. We're both, let's see here, credit card and auto delinquencies are approaching 7% through quarter one. That's a pretty big, steep incline. Same with the debt service ratio. And then, let's see, revolving consumer credit outstanding, definitely on the rise here, 1.2%. And then the personal savings rate is at 4.8%, which is the lowest level we've seen.
What's the average? Does it say the average?
Average is 8.9%.
Oh, double.
Yep. And then revolving consumer credit outstanding, 6.3% of disposable income. So
I think it's important to continue to emphasize this, that the bad news is good news. The Fed wants to see things get worse. That's the whole point of them raising interest rates, because that's how inflation comes down. Yeah. And the economy was way too hot. Yeah. And like you said, it's very resilient, Nate, probably mostly from all the stimulus during the pandemic. So it's kind of like uncharted waters. But for the fight against public enemy number one, bad news is good news. So bad economic data is good for inflation coming down. They just are trying to balance not breaking it, which is what they're talking about. Like a mild recession or no recession is always the goal, soft landing, but a mild recession is always the best. They don't want to break this by raising interest rates. So that's why they pay so much attention to the data, and they're trying to see like, okay, how much should we raise? Should we stop? Because it's tough, right? And we've seen how skewed the data can be sometimes. Like, how can you make a good decision based off of that stuff? You know, It's like tough. I feel like it's really hard to be proactive. They're always, I feel like, very reactive with some of this stuff.
Yeah, I mean, so what is it? Usually typically takes about 12 to 18 months to feel the impacts of a rate hike. So when, like, a lot of people have been anticipating them, either stopping, going on pause, or starting to reduce rates. Like if we were talking about this, and we probably did a couple months ago, say, oh yeah, it looks like June or July expecting rate cuts. My struggle with now thinking that there's going to be rate cuts coming soon it just doesn't make any sense. If it takes 12 to 18 months to feel the impacts of this, and they just did it last month,
you won't feel the impact of a rate cut for
so they
a long
did that
time.
for what reason?
Yeah,
To just temporarily shock the system a little bit. Like if they're not going to keep them higher, then what was the point of doing it?
So because we don't know what they're going to do with rates at the end of the day, let's just assume they don't raise again in the next Fed meeting. How does that impact our listeners? If let's say the Fed stops raising, at least for the next couple of meetings, they don't ease, but like the biggest probability is they raise another 25 or they don't raise at all. Right. Let's say they don't raise at all and they just stay. What is the impact on our listeners? And I guess it's not like a direct impact, but I guess what's the conclusion they should draw from that?
Yeah, I mean, you could theoretically think that portfolios might hold up, do decent. I would think that markets would react positively to that.
Yeah.
Or at least not react negatively.
Right.
At least neutral. But like immediate impacts, I would say nothing. You're gonna still have higher credit card interest rates, higher cost of borrowing.
Right.
Lending's gonna be harder to get your hands on stuff.
Right. That should signal to you that if the Fed stops raising rates, that should signal to you that maybe they think they're winning against inflation finally.
Yep. Mm-hmm. Yeah.
So that should be the takeaway. No more hiking rates. Looks like they think inflation is coming down.
Yeah.
Which is good.
Yeah. It would say that they believe they've done enough, and if they stay here for a little bit longer, they've got it under control.
And the good news is because they've had that whole transitory thing, they've been very steadfast with we are going to keep doing this.
Can you believe that they were saying that?
Yeah, I try not to give them a lot of flack for that, dude, because like how was anyone gonna know? And like they wanted to it's all about like they have to taper expectations. So like during that time when the world was in chaos because of COVID, everyone was like the country is failing. Like what were they gonna say? Oh yeah, this inflation thing we're literally done for.
Yeah.
You know what I mean?
Yeah, no, I agree with you, but there are also easy ways to say, I don't know what the numbers were, but they put how many trillions of dollars on their balance sheet that money just went into the economy.
Right.
We increased our debt levels by so much in such a short period of time that like you should be able to theoretically see that a little bit coming ahead of you at the very least. And that's where like I think a lot of the banks that are in trouble really did get it wrong. It's like, how do you not anticipate rate hikes?
Yeah.
After they printed that much money. But yeah, no, I mean, they did what they had to do. I don't think that they could have done a whole lot different. They could have printed less money, I would say, but
right.
The reality is they had to do something.
You were talking earlier about the percentage of companies in the S&P 500 that are still negative year to date.
Yeah.
And I think this is something that people should understand. And so when it feels like it's really obvious that we're headed to a recession and that the stock market is going to go down. That just seems like very rational and like it's going to happen, right? Mm-hmm. What I feel like, and again, this is why it makes investing so hard, is what a lot of people don't realize is like there has already been a ton of pain in the market. Mm-hmm. If you go pull up, if you're listening, go look at the underlying holdings of the S&P 500 and filter by the worst performers first. And it's going to take you like 10 pages of going through the holdings until you're going to start to get to a positive returning stock.
Right.
And some of these are really, really bad. And that's with the year so far. Like this is something we usually open with is like the data points year to date. Where are we at year to date right now on the S&P 500? Like up 7 or 8%?
Coming into today, yeah, it's like 7.91% on the S&P 500 and 24.74 on the NASDAQ.
Right. So 7 to 8% on the S&P 500 and 24% on the NASDAQ positive year to date. That's really, really good.
Yep.
But if you look under the hood, what percentage of the companies are still negative?
53%. 260 year to date. This is through yesterday. 266 of the 500 companies in the S&P 500 have negative performance year to date. So I think they're the two biggest ETFs in the world. Maybe not SPY and QQQ. SPY. so again, that's 7.91% year-to-date return on the market cap. So basically, based on their market cap, that determines the percentage of the index themselves. If you do an equal weight, so every company in there is equally weighted, the performance of an equal weight S&P 500 is negative 0.39%.
Year to date?
Yep.
What about, like, do you have other data on, like, if you want to look at last year?
I don't have that.
Okay.
Like, right
trailing
here,
12 months? Anything like that?
I can get it.
If not, no big deal. But my point that I'm trying to make is you look at just the S&P 500 and you think to yourself, like, oh, man, we could go a lot lower than where it's at today.
Mm-hmm.
And that makes sense when you hear all the bad news and leading economic indicators are starting to point towards a recession and whatever. But the market's a forward-thinking thing, and it's been pricing in bad stuff, right? And if you look at the underlying stocks, a lot of these positions were down 70%, 80% at its worst. Mm-hmm. How much lower do people want this stuff to go? Right. To zero?
Right.
Like, so this is what makes investing so hard. It seems obvious. We're probably going to recession, and then the stock market's going to crash and whatever. But it's priced in a lot of bad stuff already. Mm-hmm. So has it, you know what I mean? Like, I don't know if I'm making my point here, but it's just, it's not that simple.
So here, this will help a little bit here.
Like, NVIDIA today is going to pull the whole S&P 500 up. I don't know what the S&P is right now today, but if NVIDIA is up 25% on the day, and they're what percentage of the S&P 500?
Right. It's crazy.
They're holding up so much of the bad performers.
Yeah.
So it's not that clear cut.
Yeah, looking at the index like that, especially with like how big tech is really misleading.
Yeah.
Mm-hmm. Like the S&P is supposed to be a proxy for the market, and it's like, is it really?
So this is as of yesterday. To get back to the January of 2022 peak, we would need 1 year performance in the S&P of 18.3% from yesterday, 1 year forward.
To get to what?
To get back to the January 2022 peak. Okay, 18% in the S&P 500 to get back to the peak where we were at.
To set new all-time highs.
Yep. 2 years, you'd need a 9.7% average rate of return or 20.3% total. 3 years, 6.9%. Or 22.3% total, and then 5 years, 4.8% average, or 26.5%. So we still got a while to get back, even though those companies and the net, like these indexes are doing pretty well this year. We still got a lot to go before we get back to where we were. I think that the concern is like how companies are starting to look pretty expensive again. So prices are compared to earnings, they're pretty expensive.
But is that true, or is it kind of the same problem of the big 5 or 10 in the S&P 500 are expensive, but the other 90% aren't?
Yeah, because it's weighted. It's not equal weight. Right. If it was equal weight, it would look a lot different than that. But based on the market cap, yeah. So
people, just to make sure this is another good thing to learn. When you see the S&P 500, it's the price of it is not simply just the all 500 companies averaged together. Mm-hmm. It's weighted to the bigger companies.
Mm-hmm. Right?
So Apple, Facebook,
30% of the S&P 500 is just in the top 10 companies. 30%.
Yeah, there you go.
So there's 490 companies in the bottom 70%.
I would love to see how those companies are looking.
Apparently very bad. Because the equal weight would be negative.
Right. Yeah. So when you think about, where's the crash? Why isn't the stock market crashing? It has. Yeah. It's just the 10, the 30 are propping the whole thing up.
So listen, this is even worse. So switch over to the NASDAQ, 100 companies, 57.8% from the top 10. 57.8% of the NASDAQ 100 is from the top 10 companies. Mm-hmm. If you do the equal weight return, 11.68% compared to the index return of 24.74%. Mm-hmm. And then 26% of companies in the NASDAQ are negative year.
Which you cut the return in half if you equal weight it?
Right.
Crazy.
So, you're seeing, I mean, let's see. Largest position in the NASDAQ, Microsoft, is up 30.87% year to date. Apple, 12.46% of the index, up 32%. We'll go to NVIDIA before today, was up 109%.
It's
That's 5.5% of the index.
Any company that has some tie to AI is ripping, and everyone else is holding on for dear life.
Yeah. Looking at these top 10, there's one company that has under 20% performance in the NASDAQ, and it's Pepsi, 2.34%. And then looking at the S&P 500 of the top 10, we have one negative, United Health Group, negative 9.31, and then Berkshire's up 3.66%. Everyone else is up over 30% in just the top 10 holdings. So this is a narrow market. So the reality is if there's news bad enough to bring these big ones down, we're going to see some turmoil. I don't know.
What would the news be to bring those?
A war, probably.
So what should our main takeaway be from the Fed meeting and inflation data? I'm thinking that the Fed thinks the fight against inflation is working, and you can tell that based on if what their next interest rate decision is going to be.
So they need to get PCE under control.
What's PCE?
That's personal consumer expenditures. Personal consumer expenditures. Am I saying that right? Consumption expenditures. So that's like when you go to the store, like the actual stuff you're spending your money on. It's at estimated 4.5% for April. It was 4.5% month over month in March. We need that number to get down to like 2%. So there
2% is the target,
right? Because that's the stuff that you really feel. Like that's your everyday spending. So if and when that gets under control, then we're going to be in a really good spot. I think there's probably room for another hike or two, but I still don't see the point if they're just going to cut them in 3 months.
I don't see them cutting. That'd be weird.
Yeah,
that'd be like going against what they say.
Yeah,
which they don't want to do.
Yeah. I think the move is, and I don't have a clue, but what they should do, but stay where we are right now.
Chairman of the Fed board.
stay where we are right now until we're all the way there.
Fed chair on the pod.
Dude, I think that he'd probably get on. Mark, this isn't a direct recommendation, but look into the camera. You are answering the question, what if I'm 20 to 50 years old, what should I do with my 401k right now? Look into the camera.
20 to 50 years old.
This isn't a recommendation, though, but look in the camera.
I would buy a lot of equities.
No.
Dude, I saw something this morning that the amount of people who own U.S. stocks is at an all-time high right now. So they're taking your advice.
I think that the correct answer there, Mark, was nothing that I was waiting for you to say. But yeah, I mean, I guess that works too. But the answer is nothing. Yeah. People are probably asking that, like, what should I be doing with my 401k, right? The answer is nothing.
You ready for these performance? So asset class performance is the major ones. Large cap stocks up 7.9%, like we said. So that's your S&P 500. Mid caps up 0.7%. Small caps up 0.9%. All of the performance in the markets coming from the large caps. Go international. Developed markets are up 9.4%. Emerging markets up 2.4%.
What about bonds?
Bonds aren't doing a whole lot. The U.S. Ag up 1.67%.
Does that include yield?
No, yield is 4.68%. Yield's nice. And then corporate bonds up 1.84%, and the yield's 5.42%. So that's where when you see them start to cut rates, you're going to see price performance on the ag and corporate bonds. Everything's going to start to go up price performance wise.
Right.
But you'll start to see that yield eventually change.
So inflation's getting a little better, and we're just hoping to avoid a recession.
Yeah.
Yeah.
Let's wrap this up. We got like 5 minutes.
I'm good.
Yeah, I think so too. The
unemployment's still super low, 3.4%.
Dude, that's a whole nother like beast though. That's such a weird thing.
Consumer sentiment has been getting worse again, but
dude, if they can somehow keep it as a mild recession and unemployment doesn't go sky high, that's a win.
Yeah.
But like, does inflation come down meaningfully if unemployment doesn't go up very high? You know what I mean? Like, how low can you get inflation if unemployment doesn't go up?
I think if you're patient about it, it's gonna come down.
Right.
It'll that's where it's like, leave them where they're at right now for another year. Okay. Leave them where they're at for long enough to where it's gonna come down on its own without destroying the U.S. economy and crushing GDP. Spiking unemployment. Can they do that?
Right.
I would think that the reality they should be able to.
Right.
And then all the while rates are higher, you're getting paid a fair amount of money to just wait around. You know,
Yeah.
you get close to 5% in the money market fund
Sweet.
right now.
Yeah.
That's a pretty nice risk-free rate of return.
Alrighty. Anything else?
I don't think so.
As a reminder, we are now on video on Spotify. If you guys have been seeing that, Mark, I know that was your whole push.
We are.
I got it on there.
Wow. I did
So
not know that.
we are officially anywhere that you can listen to a podcast. The number one personal finance podcast in the world.
Ooh.
Anywhere you listen to a podcast, you can listen to us, and you can watch us. But I think that's it for market updates, right?
Yeah, I think so.
Good, Nate?
I'm good.
All right, guys. Thank you for listening and watching the Max Your Dash podcast. We will catch you in the next one.
Securities offered through Securities America Inc., member FINRA SIPC. Advisory services offered through Security America Advisors Inc. Dash Capital Advisors and Securities America are separate entities.